Sequoia Capital, the venture capital giant that backed tech titans like Apple, Google, and Airbnb, has sounded the alarm. Are we in an AI bubble? Today, we're diving into the current state of the AI market, exploring whether we are in a bubble and identifying the safest stocks to buy right now. But that's not all. Stay tuned for a special bonus segment where we'll share our trading strategies that have delivered impressive return. July, we're already up 10%. So come and learn how Winston and I made 18% last month and over 100% in each of the last 2 years. I will teach you for free which trades to make and when, and how to automate profit and risk management. Just head over to felixfriends.org/webinar and grab yourself one of the last 300 tickets. It's free. But let's get started. Welcome back to the channel. Today we're diving into the AI frenzy and asking the big question. Are we in an AI bubble? And if so, what are the safest stocks to buy now? But first, meet Winston, my golden retriever, and the real brains behind our trading strategies. Just kidding. Or am I? Golden retrievers are pretty smart. In September 2023, Sequoia Capital posed a critical question. Where is all the revenue? Where is the money? And this inquiry highlighted a gap between the revenue expectations from AI infrastructure investments and the actual revenue growth within the AI ecosystem. Fast forward to today, and this $200 billion question has ballooned into a $600 billion conundrum. Nvidia, now the most valuable company in the world, exemplifies this phenomenon. Their data center run rate revenue has skyrocketed, yet the implied AI spend and the revenue required for payback have also surged, indicating a massive economic hole that needs to be filled. Several key factors have shifted since the initial analysis from a year ago. So the supply shortage has eased. The GPU supply shortage that peaked in late 2023 has subsided, making it easier for startups to access GPUs. The days of startups begging anybody who had a GPU for access are long gone. We've got growing stockpiles. Major cloud providers like Microsoft have significantly increased their GPU stockpiles, driving hyperscale capital expenditure to historic levels, nothing like what we've ever seen before. And OpenAI continues to dominate AI revenue with a substantial gap between it and all other AI startups. They're basically non-existent. And even with an optimistic revenue projection for tech giants, the gap is now about $500 billion. Now, there is some good news. The upcoming B100 nvidia chip promises better performance at effectively a lower cost, likely spurring yet another wave of demand and potential supply shortages. But to understand the current AI frenzy, let's draw parallels to the dot-com bubble of the late 1990s and early 2000s before we look at what stocks we should actually be buying today. During the dot-com bubble, stock valuations soared as investors poured money into internet-based companies, many of which had little to no revenue. Now, here's a real story. I worked in a dot-com company in 1999, and the last office I ever rented for one of my businesses was in a building called .com House. They've taken that sign down since. Now, the bubble burst when it became clear that these companies could not deliver on their lofty promises, leading to massive losses for investors. Similar to the dot-com bubble, today's AI investments are driven by high expectations and speculative fervor. The $600 billion question posed by Sequoia Capital, see, I didn't even say cockroach in the same sentence. It's good, wasn't it? Highlights the enormous gap between the current AI infrastructure investments and the actual revenue being generated. Now, this gap is reminiscent of the overvaluations that we saw during the dot-com era. Let's compare that 600 billion number, which is the amount of revenue per year that we need to pay for the GPU expenditure that the big tech companies are undergoing right now. So let's compare that 600 billion number to the current revenue of the Magnificent Seven stocks. Apple is currently bringing in close to 400 billion in revenue. Microsoft, close to 200 billion in revenue. Google, 250 billion in revenue. Amazon, close to 500 billion in revenue. And nvidia, 30 billion revenue or something like that right now. Meta, 100 and a bit billion revenue. Tesla, heading towards the 80, 90, 100 billion in annual revenue. So collectively, all these companies together bring in about $1.5 trillion in revenue. But the 600 billion gap in AI revenue required underscores that this is all still quite speculative, because the amount of AI revenue they're bringing in is pretty tiny. It's probably 10, 20, 30 billion tops. So the parallels between the current AI investment frenzy and the historical speculative bubbles are a little striking. High fixed costs, low marginal costs, which basically means it's expensive to build a data center, but to add an extra customer to the data center is very, very cheap. So it's a great business. It creates a moat, if you will. It makes it hard for others to enter because you need that many billion to set up the data centers. But then, as I say, every new customer will cost you very little to add, so your profit margins are good. But there is very rapid depreciation of tech, because the current GPU capital expenditure is a little bit, well, some people are saying it's like building railroads. And I don't think that's a particularly great comparison point, because you build one railroad that connects, New York to Chicago or something. You're not going to build like 5 in parallel, right? Whereas with GPUs and cloud computing, yeah, we still have the big 3, 4, 5 companies building these infrastructures in parallel. So there is competition. And a railroad, once it's laid, will actually last for quite a long period of time. Whereas with the speed of NVIDIA's innovation, today's chip in 2 or 3 years' time will be like, a 1996 phone or something. It's like a brick. Despite the speculative nature of the current AI landscape, there are opportunities for savvy investors. And that's what you are, isn't it? So here are some of the, in my opinion, safest stocks to consider, and they have gone through the Winston check. So, golden retriever approved and all that. Number 1, nvidia. They're the leader in AI hardware. They're well positioned to benefit from the ongoing demand for GPUs. As long as they keep cranking out GPUs that are much faster than the last version and more efficient and cheaper to run, everybody else will keep buying them. So in many ways, you could say they're the safest play. Then we have Microsoft. Very significant AI investment in cloud infrastructure. They remain a very strong player in the tech space. And in my opinion, if anybody is going to monetize AI, it'll be Microsoft. Why? Because Microsoft is really, really good at selling really, really average products. They've mastered that. Google, well, their AI initiatives and their cloud services do make it a key contender. If they can catch up on the whole search race and just make Google search not a 2000 experience, which it basically still is. It has changed very little over the years. It's just text, right? No context. It doesn't know you. It's very, very, very limited. To catch up with that, they are likely to continue to dominate advertising, which is really what that business is all about. And we have Amazon with AWS, Amazon's cloud service, which continues to be a dominant force in cloud computing and AI services. If you haven't tried their ChatGPT competitor, which is called Claude, and you have to say that with a weird French accent every time you use it, it's really good. It's very, very good. It's in many ways better than ChatGPT. It sounds a little bit more human. It's a little bit less good at facts, and it does make stuff up. Yeah, seriously. I asked it for a bunch of quotes the other day. Give me some quotes on Elon Musk. And it gave me this beautiful list of quotes. And I said, can you give me the references for them? And it gave me a beautiful list of links. And I clicked on each of the links and none of them worked. And I said, well, why do none of the links work? And it said, the quotes are illustrative quotes of the sort of thing that Elon might say. And the links are illustrative links. And I'm like, okay, so you just made that up. But you didn't tell me that the first time around. So a little dodgy, but they all do that. AI is a little dodgy still right now. Now, the next company that I do like is Meta. Why? AI-driven social media and VR is what everyone talks about. But really, all I care about is advertising, right? Meta's front-end business, what you see, all the pictures and all the reels and all of that, that's not what their business is. That's just there to get you in. It's like a TV. You turn on the TV, you get all those TV stations, right? That's not really the business. The business is advertising or subscription revenues. In Meta's case, it's advertising. So they just got to keep you hooked. And the more AI allows them to understand you and your weird particular psyche, why do you enjoy watching kitten videos and weird stuff people do with smoothies and, what strange stuff that people watch, the better they know you, the better the content that they can suggest to you. And therefore, you're going to spend more time on it, and therefore they can show you more adverts, and therefore Meta's going to make more money. That's the business, right? Now, there's another one here, which is Tesla. In my opinion, Tesla is a truly unique player in the AI space, and they are likely to monetize their AI investments through self-driving subscriptions, which is already a thing, right? People are already paying for FSD, and robotaxis. Plus, they are essentially their own customer in a sense, because they're using the AI tech to enhance their own products and their own services. So I quite like that. Now, speculative frenzies are an inherent part of every tech advancement wave that we go through. And while the road ahead for AI is going to be long and tricky and interesting and lots of made-up content, it also holds tremendous potential. And I think investors who remain level-headed here and improve their skills and learn will get very, very, very much rewarded. Much like Winston gets rewarded every time I have a banana. He always needs to have a little bit of my banana. He just sits there and he just goes, come on, please, please. Started because when we hike, I always share some of my banana with him. So there we are. Now, let's take a chronological walk through the 2000 dot-com bubble and bust to understand what actually happened and what we can learn from that. So the dot-com bubble began in the late 1990s when the internet was still in its infancy. Investors were excited about the potential of the internet to basically revolutionize business and society and everything else. And companies with .com in their names were all worth a gazillion dollars by the end of the week when people realized what it meant, even if there was no viable business or no business model or no revenue. That's a little bit different now, right? So from 1995 to 2000, the NASDAQ index rose fivefold, driven by these tech stocks. And companies like Pets.com and Webvan and eToys were household names, despite having little to no revenue. And the mantra of the time was get big fast, and investors were willing to pour money into these companies in the hopes that there'd be profit in the future. The dot-com company I worked for, they were making chatbots. And the motto of the venture capitalist, Cockroach, who paid us was spend as much as possible, literally. Cash burn rate was our success. Weird times. So by March 2000, the bubble began to burst. I remember because I sat in the office when literally the lights went off, and investors started to realize that many of these companies would never become profitable. So the NASDAQ fell by nearly 80% over the next 2 years, wiping out trillions of dollars in market value. Companies that were once valued in the billions went into bankruptcy, and many investors lost their life savings. The dot-com bubble taught us several important lessons. Revenue matters. Companies need to have a viable business model and generate revenue to be sustainable. Valuations can be nutty. High valuations based on future potential can be very risky if the potential is never realized. 3, speculative frenzies are very, very dangerous. When everyone is rushing to invest in the next big thing, it's easy to get caught up in the hype and make very poor investment decisions. So are we in an AI bubble? It's hard to say, but there are certainly some similarities to the dot-com bubble. High valuations, speculative investments, and a focus on future potential rather than on current revenue are all present in the AI market today. But there are also differences. AI has already shown its potential to transform industries and create value, and companies like nvidia, Microsoft, and Tesla are generating significant revenue from their AI investments in one way or another. So make sure to grab one of the last 300 free tickets to our exclusive webinar where we share our trading strategies that have delivered pretty impressive returns. July, we're already up 10%. So learn how Winston and I made 18% last month, over 100% in each of the last 2 years. Just visit felixfriends.org/webinar. Stay informed, stay strategic, and keep learning.
Early December last year, we thought S&P could reach 5,200 this year. And we're going to be making a lot of new highs over the next 5 years anyways.
Tom Lee famously just predicted a 15,000 point S&P 500, so I dug deep into